If you are investing in the stock market and do not understand how taxes are calculated or paid, you are potentially losing thousands and hundreds of thousands of dollars over the life of your portfolio. So in this part 3 of my series, Stock Market Taxes for Beginners Explained, I am going to go over the basics of dividend taxes and how they are calculated so you know how much you could potentially owe. Quick disclaimer, I am not a tax professional. I am not an accountant. This is based solely on my own research and experience with investing over the past couple decades. Please always do your own research and your own due diligence and reach out to a financial advisor or a tax professional if you have any specific questions on your unique situations. This video is only going to explain taxes on dividends in taxable brokerage accounts. This is not a video that explains dividend taxes as it relates to retirement accounts, so 401k, IRAs, etc. What is a dividend? A dividend is a piece of the profit that a company that you have invested in shares with you, the stockholder, typically on a quarterly basis. Most companies pay dividends as cash, but it is sometimes possible to get them as stock options, or even property. First thing you need to know about dividends is that there are two types. There are what are called qualified dividends and ordinary dividends. So qualified dividends are dividends that are going to be paid out typically from U.S. corporations, larger blue chip stocks, Microsoft, Apple, Coca-Cola, etc., or foreign corporations that have some sort of agreement with the United States that are also traded on the stock exchange. They are going to be taxed at reduced tax rates than what are called ordinary dividends. Ordinary dividends are going to be things like your real estate investment trusts, limited partnerships, and other things like that. They are going to be taxed at the regular tax rate, which is your income rate. A dividend is also typically classified as qualified if you have held the underlying stock for a certain period of time. If you aren't sure if a dividend is a qualified dividend or an ordinary dividend, always reach out to your brokerage account company or your CPA, and they should be able to help you distinguish which one is which. Very high level, the more qualified dividends you have in your taxable portfolio, the better. So how do you know how much in taxes you're going to pay on qualified dividends? Well, qualified dividends are taxed at long-term capital gains rates, which, if you remember from part 1 of the series, receive much more favorable tax rates than short-term capital gains. So the chart on the screen now is the 2025 qualified dividends tax rates, and it depends on your income level and how you file your income taxes. As an example, let's say you are single and you make $150,000 in taxable income in 2025. When you go to file your 2025 taxes in 2026, your qualified dividends are going to be taxed at a 15% rate. You would pay the same 15% rate if you were married filing jointly if your combined taxable income was $350,000. Non-qualified or ordinary dividend income is taxed at the regular income rate. So the chart on the screen now is showing you for 2025 the breakdown of the income and the ordinary tax rate. So you can see for ordinary dividends, the income goes down and the tax rate goes up. This is why ordinary dividends, you will pay more in taxes on ordinary dividends as opposed to qualified dividends. The one other thing that comes into play with this is what's called the standard deduction. So the standard deduction is set by the IRS every year, and it is by which you can, as a taxpayer, reduce your taxable income depending on your filing status. So the chart on the screen right now is showing you the current standard deduction amounts for 2025. So this just means that whatever your taxable income is, you can take off this amount, and that will then be your new taxable income if you are claiming the standard deduction on your tax return. And to claim it, all you have to do is check the box that you want to claim it on your tax return. Let's look at an example of how this is calculated. So let's take you are married filing jointly, and let's just say you're retired. Let's say you're not bringing in any W-2 income, self-employment income, anything like that. But let's say that you made $80,000 in qualified dividends last year. So taking in the 2025 standard deduction for married filing jointly of $31,500, you could make $80,000 in qualified dividend income and pay 0 taxes on it. On your tax return, it will ask you to split out both your ordinary and qualified dividends. And so if you need help with that, again, see your CPA or your accountant. One thing to note is you might not receive a 1099 dividend form if you made less than $10 in dividends for the previous calendar year. But even if that's the case, you still should report that as income on your tax return. Now, you can avoid paying taxes on dividends with certain types of retirement accounts. So I'll do a separate video on that later. If you found this helpful, follow along, leave a question in the